So I guess we won't talk about all 45 reasons why this insurance issue is going on. The mom and pop property owners at a risk of not being able to pay their bills, pay their mortgage, brush a high risk that's affecting our client's property, but it's the government's land that they're not maintaining.
A little hypocrisy there.
Just a little. But that sort of thing, it blows my mind that we have these prices because our local government and whoever owns that land is refusing to maintain it. I guess we won't talk about all 45 reasons why this insurance issue is going on, but number one's the wildfire. That's the number one issue of increases. Is number two some of the material issues of like breakers and plumbing materials, or what's the second most common reason why this problem with insurance has gotten so bad?
In terms of availability or cost?
Both, I guess. Or is there a difference between availability and cost?
There is a little bit, yeah. As far as the cost is concerned, the rate-making process, they have to basically look forward based on the rules for the Department of Insurance. Some of these carriers had requests for rate adjustments in to the Department of Insurance for 4 years or better, based on losses that they've sustained years ago. And looking forward, their predictions for what the losses would be going forward from that 4.5 years ago have proven to be true because of the wildfires that are there.
So in some ways, it's kind of what our clients deal with as property owners, where the state or the municipality are saying you can't raise rents in order to protect consumers, but then mom and pop property owners at a risk of not being able to pay their bills, pay their mortgage.
Right.
Basically, there's a level of that happening to the insurance carrier now.
Correct. And again, it's a dollars and cents thing. It comes down, if you can't get an adequate rate for the risk, you have to do one of two things. You stop doing it or you leave the state. Yeah. And if they cannot keep the policyholder surplus up to the level that it needs to be based on what their risk exposures are, less reinsurance and other things, then the insurance commissioner can shut it down. But the insurance commissioner is telling them, or not telling them anything actually, because they're not allowing the rate-making process to go through.
And this is an elected official.
It's an elected official as opposed to an appointed position.
So there's some motivation to be able to, want to continue to be reelected by the consumer, by the general voter.
That's exactly it. It's, I don't really want to get into politics. Yeah, I'll stay away there. But California prior to pre-Proposition 103 was what they called a file and use state. The insurance carriers could file new rate systems or new rating, and as long as they had the ability to back it up, and within 6 months if the insurance commissioner did not say no, they could use those rates. That went away. And it's been kind of a little bit of turmoil ever since. But because of what's going on with the wildfires, the liability losses, the tort laws in California, there's the multiple different factors.
From what I remember from when the fires first happened, the governor put in a moratorium, an emergency stop on carriers. You can't cancel.
Yes.
And you also can't raise rates for some period of time.
Correct.
In the emergency period.
Correct.
Similar with what we all dealt with like the COVID lockdowns and that moratorium on rent increases and evictions.
Yeah. If you lived in a high hazard area and had an existing policy, they could not, and even today, they cannot non-renew the policy. That was an order that went into effect for, I think it was 24 months.
So high risk area, not just the areas that were directly affected by the Palisades or Altadena fires.
Correct.
Okay, so I guess let's get to the latest and greatest, I don't hate to even call it that, wake up call this week. So this new CAL FIRE map that just came out, why don't you explain why has CAL FIRE not put out a map in 14 years? And I'm always wondering if there's a motivation here with all these new areas that are high risk. I'm assuming that means that there's a correlation that all these new areas that are considered high risk can't be touched by the insurance carriers now.
Well, they can continue to write insurance there. It's just a matter of what it's going to cost and how much of that exposure they're willing to take on. Because even in some of the high fire hazard areas, I'll use Temecula as an example. The entire Temecula Valley is surrounded by brush.
Yeah.
But you have buildings that are in the core of the valley that are not necessarily going to be affected by a wildfire if it happens because they're pretty far removed from it. Those on the outlying areas that back up to the brush, they probably will stay away from. But the ones that are in the core, the homes, et cetera, that are not in high hazard areas, they'll take it. But they've pretty much designated the entire Temecula Valley as a moderate or high fire hazard area.
Well, and even Temecula, like when you talk about Temecula, I'm thinking of some of the properties that we manage and you've helped us write insurance for. There are some properties where they're in a high risk area, not because the property owner and we as managers aren't building a defensible area, maintaining it. It's because of a neighboring property that may be adjacent. And there's even one property I'm thinking of where there's a big gully in between the two property lines. The property on the other side is government land, and that's brush, high risk that's affecting our client's property, but it's the government's land that they're not maintaining.
A little hypocrisy there.
Just a little, but that sort of thing it blows my mind that, okay, we have these prices because our local government or federal government, whoever owns that land, is refusing to maintain it.
Yeah, and it's, again, you look at some of these areas, Temecula as an example again, or Palos Verdes. A lot of these properties are built on canyons or back up to land, again, like you just said, that's not owned by individuals, or if it is owned by individuals, it's not developed.
It's like in Palos Verdes, it's a nature preserve, most of the land.
Yeah, it's, where that is, or the canyons behind the houses in Rolling Hills and all of that. I mean, those are ripe and ready for a wildfire. But again, it's, there's some pretty sheer drops there. And to try and get somebody down there to, with a weed whacker to cut the weeds down to keep it from being a brush area,
it's not gonna happen.
It's not realistic.
No.
There's not enough weed whackers in town to be able to do that. Plus, nobody wants to deal with it anyway. But
so I'll tell you what, weed whacking the what is it, 6.9 or 8.4? I don't know how many millions. We'll put the number on the screen for this part, but
yeah,
the multiple millions of acres that are now considered high risk. How is that the same but only different now, 14 years after the last fire map?
You know what? I wish I had a crystal ball to be able to tell you. It's since that map just came out, we've not heard much in the way of reactions from the insurance carriers. So we're going to find that out in the coming months, how they're going to react to providing coverage in those areas. And they're going to take a good, strong look at that risk that they already have in those areas as to whether they're going to be willing to stay on them.
Why doesn't CAL FIRE put out like an updated map annually or biannually? Why was there a 14-year gap? Is there a schedule of them that comes out?
No, there's not. And if I had to guess, it would probably be blamed on budget issues. Okay. I didn't have the people to do it.
I was imagining or assuming that the carriers maybe put so much pressure on CAL FIRE or the state that, hey, we need to know, we need an assessment of how bad this is.
Yeah, I'm sure there was some pushing from the industry, but I don't know that firsthand.
Yeah.
It may be that you have carriers that stood up and said, okay, we'll pay for it. We want to do it. And it's not just to justify the ability to increase rates. They're, again, looking at the risk that they're absorbing for the premiums that they collect to make sure that they have the money to be able to pay claims if they happen. And that's the single biggest thing. We can't kid ourselves. They are in the business in California to make a profit.
Like any business, they have to.
Exactly.
They have shareholders, they have owners of the business that
exactly
they have expenses and they have a bottom line and have to meet those needs.
Exactly. But if they don't have the money to pay the claims, then the regulators are, will try to fix that, and we as the consumer end up paying for it anyway. So it's hypothetically, if you had a big name insurance carrier, you'd pick any one of them that no longer had the surplus to pay claims for $2 billion fire loss.
Mm-hmm.
Okay, they would go back to the California Insurance Guarantee Fund, which the consumer funds.
Yeah.
So it's either pay the premiums or you pay it later. So it's
the money's going to get paid somehow.
Exactly.
As which pocket is it coming out of?
Exactly, and it's which pocket of the consumer is it coming out of? We still pay for a piece of that through the premiums that we pay, but if you remember a few years ago, there was actually a surcharge that appeared specifically on your policy for the SIGA surcharge.
Yep.
And it was, at one time, it was about 2% of the premium that you pay, which if you're paying $500, that doesn't amount to much. If you're paying $500,000, it's a chunk.
So what reactions are you hearing from property owners? I know my reaction on behalf of my clients, and I know what I hear from them before or after I get the news from you on the insurance premium cost or the non-renewal notice we receive. It just feels like it's harder and harder to even find available coverage. And I'm wincing every time I get the email saying from you or from John saying, hey, here's the premium that's ready. You usually done a good job of warning me how bad it could be. But what's the general reaction you're seeing and hearing from your clients, from property owners?
Well, they obviously don't like what's going on because of the increases. I mean, it's probably the worst one we've seen is 300-400% increases from what they paid before. Those are pretty extreme cases. 100% increases are not uncommon. compared to what they have, that's kind of a double-edged sword because the insurance carriers they're coming out of are collecting inadequate premiums for the risk that they've undertaken to begin with, statistically.
So they're trying to catch up on how far behind they are.
Right. But then on the other side of the coin, you have the carriers in the alternative markets that are not subject to the California rate filing rules that basically could charge what they want.
Mm-hmm.
So you're going into that market and it's whether it's greed or, hey, we'll throw a number at it and see what we can get kind of thing. There's probably a little bit of that goes on. We've seen it in a number of cases with, just umbrella liability policies and those kind of things because they're the only ones that are going to offer it.
Are you seeing any property owners, I hate to even say this, like, I guess I hate to say because I can't imagine anybody could at this point with how much news we've all seen, anybody sticking their head still in the sand or underestimating how bad this problem is?
I'm sure there's a few, but, as you know, we make a habit out of communicating up front that this is what we're going to be staring at when this ultimately gets taken care of. There's no way to sugarcoat it. Nobody's going to say, well, yeah, it's only going to go up 20%. Wrong answer. It isn't going to happen. Anybody that tells you that has their head in the sand. That's not going to happen.
I know we're telling clients that, and we're just you're telling real anecdotal stories of what we're seeing when policies come out that, I think the worst case scenario was a 500%, if I'm remembering correctly, one of the Temecula properties a couple of years ago. So we've told them that's the worst case is 500%, but 100% increase is what we're telling clients that don't be surprised if it doubles.
Right. Exactly.
Property that we just finished getting a policy in place in Huntington Beach, I think that was at least.
Yeah, it was 150, 200%.
At least that. Yeah, it was not a small increase. And that was like, oh, we're good.
Yeah, we got coverage.
Yeah, we've got coverage, and it's not as bad as we thought it could be.
Yeah, that's the biggest thing. And that's, I guess in a strange sort of way, that's where we have the advantage because we work with a multitude of different carriers, not just one, like the direct writers, as they say. So we could take different avenues. Different carriers have different appetites for different areas, and it's ourselves and the other brokers that we deal with have done a really good job of figuring out which carriers to go to. So it's not just a shotgun approach to try and do it. They're actually going to go to carriers who will consider a risk in those particular areas.
You know which carriers have that risk profile.
And as such, we also know or have a pretty good idea of what they're going to charge within tolerance.
Got it.
But you brought up a very good point a little bit ago, and excuse me if I'm stepping ahead of myself.
No, go for it.
Are the inspections.
Oh, anyway, I wasn't even going that direction. That's a great point. I'm glad you brought that up.
Yeah, the insurance carriers that are in the alternative markets, they are doing inspections on everything. It used to be that they would do them 2-3 years. They're now doing them every year. And just some of the things that they come up with, as an example, there's the electrical panels. A lot of the older buildings, probably pre-1970, have electrical panels that are manufactured by a company called Zinsco. Another one that is a bad news one is Federal Pacific. Some Murray panels are problematic. And what the insurance carriers are doing is they're forcing people to replace those panels before they will insure them.
And we're not talking a cheap replacement. We're talking one of the most expensive components on your building.
Correct.
So 10-unit apartment building, what's that going to cost to replace an entire panel?
That would depend on how it's set up. If it's wired where it has sub-panels in each unit.
Which you would hope it does.
Yeah. And so based on that, you would have to replace all of the ones that are affected on the forbidden list.
And it's probably, you would assume there's some level of assumption that if the main panels, Zinsco, probably used the similar manufacturer on the inside of those.
Right. It's because they were very commonly used. Whether they use them because they were the cheapest ones at the time, the most available, I mean, it's anybody's guess, yeah. But it's because of the style of what they were done, and I won't get into the specifics because that's pretty technical, but the way the breakers are seated, they have a problem with arcing. Arcing causes fires.
So are we talking a $500 expense per unit, $1,000 expense per unit roughly?
Well, as an example, the 4-unit building that my wife and I own, when we had to go away from State Farm and into the alternative market for that one, there's 4 electrical panels, one for each one of the units. Fortunately, they're not inside the units. They're all located outside. It cost us about $1,500 to have those 4 panels replaced. we got lucky because the access was easy.
Okay.
If you have the individual panels inside the house, you don't have any workaround room. So you're cutting holes in walls, doing all of that neat kind of stuff because you got to get to the conduits to get to the wiring to put it into the new panels, that you cross your fingers and hope that they line up with the inlets on the new panels. Otherwise, you're putting in junction boxes and doing all kinds of neat things. So that could be a huge expense. It could be a minimal expense. But the other things they're looking at too is plumbing. If you have buildings like galvanized pipe, forget it. The coverage is unavailable.
I remember a period of time, I think it was State Farm. They weren't doing policies. This had to be at least like 5 to 7 years ago. They weren't doing policies like in the South Bay. And I don't know if it was due to like in Redondo Beach and Hermosa specifically, there was some conversation around whatever material was used regionally in like the South Bay in the 50s and 60s was of such poor quality from like overseas that they just wouldn't touch the plumbing lines anymore. Was that because of galvanized lines?
If they were galvanized, that was probably the reason. They look at things that it's got to be 100% copper on the water lines, including inside the walls.
Because if you connect copper, I think we talked about this before, you connect copper to galvanized, you have another fire risk, right?
Well, it's not a fire, it's a water leak, because the two dissimilar metals, you get oxidation, and you're going to end up with pinhole leaks throughout the house.
Got it.
Whatever the copper is, because it just eats away at it. So waste lines are typically not as important, but the water lines and the electrical.
It's just because of the pressure of the other lines?
Yes.
Okay.
Yeah, because the galvanized is just a free flow, or the cast iron is just free flow. There's no pressurized.
I could remember a day 5 years ago plus where dealing with insurance, even though I love talking with you and dealing with you, and we love, I don't know if you love dealing with me, but
I do.
We didn't have to jump on a lot of phone calls. It was a lot of like email, like, hey, it's renewal time, there's the policy, we're done. Then it started to feel like you and I were on a phone call a lot. And then there was that point where I brought in Lauren, my wife and my business partner to start helping with the insurance because it became overwhelming for me to deal with as many policies and all the negotiations that were happening. And we started to build a compliance team. And then this year you had the idea, I think it was your idea of like, hey, I think I need to come top with the whole company or the whole operations department at this point, because this is becoming so difficult and so convoluted. And the reality is we need everybody on our property management team to be aware of the problem, looking for the issues.
There are ways to mitigate it.
It just, where do we go from here? I'm glad we have the whole team trained and they understand it. And I think you mentioned the inspections, and I know for us, we've always had the value. We saw the value already of doing regular inspections of properties and taking photos. And now even more so, it feels like it's a saving grace that we've had that all along. What else can property managers and property owners do?
I mean, what you guys are doing with your periodic inspections, monthly, quarterly, however it is you do it, depending on the property
And on the size of the property.
and those things that you inspect. Utilities are the big thing. One of the big causes of water losses, and it's the simplest thing on the planet, is the hoses from the angle stops in the wall up to the faucets in the bathroom, kitchen. It's out of sight, out of mind. Those things are there for 8, 10, 15 years. And all of a sudden, boom, it blows. And invariably it happens when nobody's home.
Or it happens when it's like a unit turnover or something. We've had one happen where it's like a brand new property that we just began managing. We're turning the unit, GC's in there, demoing the property, and go figure, angle stop blows. Luckily, it was a unit that was vacated, so it didn't affect any tenants, but
Right.
of course it would happen. Right.
But you never know if it happened. If you got a vacant unit on the 3rd floor,
Yeah.
water flows downhill.
Completely. We got really lucky with that one, yeah.
Yeah, so it can be a huge problem, and that's such a simple fix. And just from a maintenance standpoint,
Such an affordable fix. Yeah.
every 5 years, replace it.
Well, I know you and I have talked about, during so we do the external inspections, and then we have the interior inspections on the apartment buildings. And that's one of the things that we've always checked is, can you easily turn the angle stop, or is it corroded and you have to, bring in a hammer to turn the thing? It's how to replace the line.
Yeah, that is not just the line, is to replace the angle stop itself. The ones that they have now are solid brass that are just quarter turn.
Mm-hmm.
Whereas the other ones, the old style, has some plastic in it.
And it's like a knob. You have to like turn the knob, crank it a little bit to get it going.
You cross your fingers and hope that it moves, because if you try too hard and all of a sudden the handle breaks off, number one, it could leak. But number two, now you have no way to shut off the water if the other hose blows. So it's very advisable to make those changes.
Anthony A. Luna is the CEO of Coastline Equity Property Management, based in Southern California. As a respected Forbes and Fast Company contributor, Anthony shares insights that help property management professionals excel while giving back to their communities. His upcoming book, Property Management Excellence, will be available in 2025 on Amazon, Barnes & Noble, and bookstores worldwide.